Hey guys and girls, welcome to this week's episode of the No BS with Birchy podcast. I'm your host, Nathan Birch, and it's the show unraveling the truth to the facade of the 21st century. We're now exiting the matrix and waking up to motherfucking reality. That intro never gets old.
No, it doesn't.
Today, I have a special guest, Afiq.
Hi, everyone.
Coming on, or leave me hanging with her. Yeah. It's the first time on the podcast.
Thank you for having me.
Maybe if you want to give the viewers just a bit of a background on your background, your story, how we came to be, how you fit in the picture, and what we're going to talk about today.
Sure.
Yeah.
So my name's Afiq. As Nate just mentioned, I am the principal and a financial planner with Granada Wealth Advisory. I've been in the finance game, investment finance, not credit finance, for well over a decade. We'll be closing to 15 years now. Started off as a stockbroker, moved to portfolio management, then hedge fund management. Then I got to a point where I thought, you know what? I need to not work for myself. I need to exit the matrix, as I say. So I need to start working for myself, sorry.
Yeah.
And that's when I started Granada Wealth Advisory. We've been around for nearly for close to a decade now, 2017. Wow. Yeah. So 8 years. It's crazy. We do a lot of financial planning, investment advice. We've got a mutual connection.
Yeah.
We've got an accountant. That's a mutual connection of ours. He started sending me clients with Nathan.
Yeah.
And the service was impeccable, I'd like to say.
Yeah.
But the main thing was the investment philosophy.
Yeah.
I've been very heavily biased, I would say, towards property.
Yeah.
And I think that's where our philosophy aligns, because here in Australia, if you're not invested in property or mining, you're doing something wrong. We're a two-sector economy.
Yeah.
And after long chats with you, I guess this is where I am right now.
Yeah. I think it's important. Like I've always said, everyone should be their own financial advisor, right? They should be making their own financial decisions and whatnot. And I think it's important that you have those right people around you. Like for the viewers of whom you say, this is not financial advice, I'm not your financial advisor. But, you know, to get a very good financial advisor is very hard out there. And having people that understand your goals, because most advisors that I've seen over the years, it's taken us a long time to, you know, work with each other. You've had clients that have come over to you and we've got a very good understanding of what we do. To find a good financial advisor, they're one in a million. So, you know, that's why we're here today. And yeah.
Financial advice, like you said, yeah. We are absolutely where there's less than 12,000 of us in the whole of Australia.
Okay.
About 2,000 of those are stockbrokers. So they're not really even financial advisors.
Yeah.
So let's go conservatively, and let's say there are 12,000 of us. To service 30 million Aussies, it's a hard job to do.
Yeah.
And to top it off, a lot of us are, we push products.
Yeah.
Products which pay us, right?
Exactly.
So it's not holistic advice. A lot of them will say, oh, this is holistic advice, yada, yada, yada. What are your goals, etc. I've seen it with my own eyes. It's not really. They've got certain things they want to push to get the comms up.
Insurances, managed funds.
Exactly.
Yeah.
Exactly. I like to go against the grain because I like to say, okay, what is good for my client, right? Every stage of their life is different. No two clients are the same. Yeah. And the reason why I bang on with property, even though the money will be taken out of my management to purchase their property, at the end of the day, I know a good service will bring in better referrals from their friends. And that's how we've grown organically. Yeah. And I'm happy and proud to say that we've grown organically. Yeah. I do think we need to start advertising, and this podcast is probably a good wake up call for me to start. Yeah. You know, being out there and telling people what they are missing with other financial advisors. Yeah. So yeah, I think having a financial advisor that aligns their goals with your goals with their goals. Yeah. So our job shouldn't be telling you what to invest in. Rather, it should be, how do we navigate the legal requirements and the government requirements in order to facilitate your financial goals. Yeah. That should be what a financial advisor does. And if you're looking at doing anything stupid, for example, I think I want to buy this mining stock, which is a 1 in a million chance might hit gold, or I'm looking at buying this property in some hick mining town, which no one's heard about. Yeah. 90% of my job is saying no.
Yeah. Yeah.
It's literally it's holding your hand and saying no, and the rest is facilitating what the end goal is for you.
Yeah. And that's the thing. Like I've spoken to planners over the years, and they're like, "Oh, buy Telstra shares, put in a Roth IRA, do this and do that," and it's like, hang on a second, right? Like, and it's important that naturally, if someone was to take, when it comes to whether it be property advice, financial planning advice, whether it come to relationship advice, you go down the pub. Let's say someone has a relationship. I always think of this as a scenario, right? You've got someone with a relationship problem. They got two friends, right? One is happily married, goes to church every day. You got the next one, which is a drunk down at the pub and had 3 divorces, right? You go take the advice from the one down at the pub, and then you got the one that's over there, oh, it's tough, you got to look inside yourself and make sure that you're not the cause of the problem. And it's like, hang on a second. And then you go, okay, you got 2 options there to take a choice. And I feel that a lot of people would just go, oh yeah, and throw advice around, but they're not in good stead. And that's what's important, is to make sure that I always say the whole team has to be on the same page. And it's just by fate that, me and you're on the same page. We're aligned in all different aspects of the world.
Yeah.
The intro, my goal today is trying to make you to swear, right? Because he's very conservative on that front. But besides that, we know the matrix is real. We know that the world is designed to keep everyone trapped.
Absolutely. I think the more the government controls, the less control you have. So the less control you give the government, the better.
Yeah.
And I'm not here to tell you to dodge taxes or anything, or doing anything illegal. All I'm saying is the government is no smarter than you in order to spend your own money.
Yeah.
So you might as well do it yourself.
We're filming the budget. We're doing a Facebook Live on the budget the other day when it was coming out. And one of the things that got raised, which Ridwan was saying on that Facebook Live, was that the super fund, and it's a good topic for today, we're going to talk about super funds and all that. But one of the things is that the super fund contribution from the employer has now got up to 12%. Right? And we talk about a scam. We talk about a Ponzi scheme, right? If these companies, the governments didn't have liquidity going into them, there'd be a big collapse out there in a lot of aspects, right? And every time I see that we go into some sort of financial turmoil or there's an issue, the super fund just continues to go up, right? And it went from like 7%, 8%, 9%, 9.5%, 10%, 10.5%, 11%, 11.25%. Now it's to 12%, right? Yeah. And it's like they've literally just skimmed 1% of everybody's income for the year to put it into this Ponzi scheme so they can create bonds and derivatives to then go and off-sell that into supporting government infrastructure, to supporting BlackRock, Vanguard, and all the the financial engines out there, which will then go create more liquidity off the back of that. And I laughed when I saw that, right? Because it's like the game's there for everyone to play, but most people are too asleep, Don't
get me wrong. Australia's super fund industry is the envy of the world. You've got big hedge fund managers all over the US who speak about the Australian superannuation industry.
Yeah.
But
of course, because they're forcing everyone to pay 12% of their income.
At the end of the day, you're still at the whims of the market.
Yeah.
No matter what happens, these industry super funds, as good as they may seem, if the market doesn't do well, your super fund isn't going to do well. Yeah. And their excuse is, oh, the market didn't do well. Okay. Yeah. And so they're skimming your money, and they're putting it into something you can't control.
Yeah.
So when you get older, you don't rely on the government. Yeah. So essentially you pay taxes. Yeah. On top of that, your employer pays your super. Yeah. But when you get old, don't rely on us. Yeah. And you're doing this for 65 of your working life. Let's say you were a hard worker and you started working at 20 years old. Yeah. So for 45 years, 46 years of your life, you've been paying money to the government. Yeah. You make more than enough money to rely, so you don't get Centrelink. Yeah. So that scrape that off the board. Yeah. But you make too much money where you're paying 3% to Medicare. Yeah. Right? Then you make enough money where, and then you're by the time you retire, you have too much money where you can't get on the Social Security, no pension. Yeah. So someone's trying to dick you. Yeah. Yeah. What your job is think of yourself as a farm or a farmer, right?
Yeah.
Farmers are self-reliant. Not everyone in Australia can afford a farm,
Yeah.
right? But everyone in Australia who's worked hard for the first 20 years, if you started working at 20,
Yeah.
chances are you can have a SMSF by the time you're 40.
Yeah.
Without a doubt, right?
Yeah.
So your job is, as a farmer, you should farm your own super, look after it, control it yourself, right?
Yeah.
These government bonds or these ETF indexes that people are investing in, forget that.
Yeah.
That's lazy investing.
Yeah.
There are so many other ways you can do. Purchase a property, leverage up to the property.
Yeah.
And then whatever's remaining, use that as cash flow to grow as much cash as you can for the next property.
Yeah.
The equation isn't hard.
Yeah.
The execution may be a bit scary, but when you have a good team of people who look for property for you, you've got a good team, financial planners like myself, and good accountants, it becomes a breeze.
Exactly. And I look at supers, right? Because I remember in the start of the, we'll call it the illness phase, right?
Yeah, before we get banned.
Before we get banned, right? Let's call it the, right? And as that happened, like, I had clients come to me, and like, I'm no financial advisor, so I don't give financial advice, but just be like, oh, Nathan, my super fund, I had 200 in it, now it's gone down to 150, right? And it just fell off a cliff. And they're like, what do I do? I'm like, okay, well, for me, this is what I'm doing, blah, blah, blah. And then like 3 months later, or 6 months, 12 months later, person to come back and say, oh, my super fund's gone back to 200, right? And the units of how they sell them, they've gone down and they've gone back up and whatnot. And you don't see what they're investing it into. They don't show you, okay, you've got 7 stocks at Amazon or whatever. It's in a big slush fund Ponzi scheme of a trust that they have. But everyone's like, yeah, well, I had 200, went to 150, but it's okay. It's back to 200. It's like, hang on a second. Beforehand, 200 grand would have bought you X amount of coffees, right? Coffees doubled, cars have doubled, an old Datsun's doubled, your food's doubled, your power's doubled, everything's doubled. So no one's taken into consideration the inflation aspect of it. There's no hedging that's been allowed for that. And I just think, everyone should be their own financial advisor. And I know that's what your belief is as well, to make sure that our investors are equipped with all the infrastructure and the compliance and the governance to make sure that they can, successfully navigate through that and get the safety, which is important.
I have a very interesting story about the period of the illness.
Yeah.
We started seeing, or my firm and we started seeing a lot of big other hedge fund companies starting to liquidate their positions even before the market sold off.
Yeah.
And so the market sold off about end of February.
Yeah.
So when we saw it in November of 2019, so we decided, you know what, we'll see what happens. We'll see what happens in January.
Yeah.
So by January, we were up 6%, and we target about 12% a year.
Yeah.
So we thought, okay, we're already up half the year.
Yeah.
A lot of hedge funds are selling off.
Yeah.
Let's liquidate all our client positions right now.
Yeah.
So we did it.
Yeah.
Right. And the market sold off, and we thought, you know what, we're going to buy a bit and continue buying as the market goes up. So that year we did a stellar year. We did about 36% of our clients that year.
Yeah, beautiful.
But the reason why we were able to do that is purely because we had full control.
Yeah.
With your industry super fund, you do not have control.
Yeah.
You cannot buy and sell the way that we did.
Yeah.
So when we did this for our clients, a lot of probably about 70 to 80% was in property.
Yeah.
The remaining amount, the 30%, is in tradable assets, exchange tradable assets, which then the client through us is allowed to control.
Yeah.
If you look at it and you're like, okay, I feel like the market's coming down, sell it off.
Yeah.
Because that dip from 200 to 150 and then back up, that's opportunity cost.
Exactly.
That is opportunity cost that people think, oh, it can back up, but you've just lost 6 months.
Yeah.
And your $200,000 isn't worth the same $200,000 6 months ago.
Yeah.
And you're right.
Yeah.
It's just because we've been so desensitized towards things and just seeing numbers are just numbers. We don't realize, okay, what is the purchasing power per dollar?
Yeah.
What is the cost of goods now?
Yeah.
Right. So I think that's something that we need to start considering and need to think, okay, what is in my best interest? Because that 6 months and that dip from 150 to 200, so 200 to 150 back to 200,000.
Yeah.
Imagine if something were to happen to you and and that money, your family needed it,
Yeah.
you just left them 150 grand less
Yeah.
purely because you didn't have control.
Yeah.
And everyone right now, I repeat, everyone right now, whether you have an SMSF or not,
Yeah.
you have the ability to control your super
Yeah.
as long as you get the right advice.
Yeah. And I guess like some people might be watching this and going, yeah, cool, I've got a super. Like everyone would have a super out there. 9 out of 10 people would have a super of some capacity. People just go, I never look at it, right? And I always think to myself, like if we're talking about an investor mutual clients and that, they might have 250K in their super and they're going to do a self-managed super fund. The way I look at it is that that's $250,000 that you don't know. Like I always ask people like, okay, you got $250,000 in your super. Yep. I think so. Maybe. Yeah. Something like that. They never know exactly. Last time I looked, it was, it's down another 20K or it's up 10K, whatever. And then I go, okay, so who do you deal with there? Who's the person that you speak to, right? Oh, I don't know, right? Well, wouldn't you know if someone's got $250,000 for your money, where the fuck that is, right? Mm-hmm. What have they invested in it physically? Oh, I think it's into some shares or something, right? And it's like, is it shares? Well, what shares are it invested into, right? Did they put it all in the WeWork, right? And then it's gone bust, right? And people can't answer that, right? If you can't answer one of those questions, it's like, hang on a second, there's a very good valid point that needs to be questioned here. Who the fuck's got $250,000 of my money, and what can I do about bringing it back home and in my control? And you can do a much better job. When
I started this, the best thing my old boss taught me was, put your own money in it, and you'll learn very quickly. So I was 18, fresh out of uni, 19, fresh out of uni. Before that, I was waitering, so I was in hospitality. So $6,000 back in those days was a lot of money to me. So I took all my savings, which is $6,000, put it in the market. And with my boss's guidance back in those days, we managed to turn that to $36,000.
Super.
But you have to remember, it was a massive learning curve. I could tell you where 50 cents went, because I looked at that so carefully, and that was $6,000 flipping dollars. Now you've got people with $250,000 who don't even know that they're being charged 1+%. That's $2,500 a year.
Even if the fund's done nothing.
Don't even know.
Even if the fund's done nothing.
If the fund's done nothing. And you know what's even crazier? Some funds have performance fees. So if they've done nothing and they make you a little bit of something, they charge everything extra. So it boggles my mind. You have, I was struggling to part with $6,000 and not knowing where it went. That people here are sitting with $250,000 who not only don't know, don't care about where it's going. So you need to change that mentality.
The way I see this, I've always made this reference. Back in the day, there was that Wolf of Wall Street movie, right? And everyone was like, oh, cool, Wolf of Wall Street, right? It's about a fucking scammer that's ripping people off, right? That's the reality of the story. And, the Wolf of Wall Street is from Wall Street, right? Who's playing with these funds, right? Where are they, right? That's your financial future, whether it's a mixture of Wolf of Wall Street and a pole of communism, right? That's who's playing around with your money. And, you should be invested to go, hey, there's no play on words there, right? You should be invested enough to yourself to go, hey, what am I going to do? How's that going to help me? Because if you structure it right, maybe we'll do a whiteboard session on this one about talking about different options of if you have it in a normal super fund or put it in a self-managed super fund and the benefits and whatnot and strategy behind it, some stuff like that. So keep an eye out for that video to drop once we get a chance to do that video.
Absolutely.
But yeah, people should be paying a lot more attention as to how that's going to help the overall portfolio, in my view.
I agree. There's no better time than now to take control of your super fund. So let's say you had less than $250,000.
Yeah.
And you thought, okay, I've got $100,000, Afiq. What can I do? What can I do to boost up the returns on my super? I'm already contributing 12% a year. Your average super returns between 6 to 7% a year. And I can almost guarantee you that if we put it in a high growth return for you, you're getting close to 10% with pretty much the same or a bit less fees. Right? You could get your super, incubate it, and aggressively grow it. Make sure then you grow to 200,000+, turn it into an SMSF, purchase property. So for everyone who's watching, no matter what your balance or your super, there's always ways to accelerate the growth of your super.
Yeah. So I guess if we go from the basics, right? So you mentioned there, 200 grand, 250K. Pretend that someone's like, I never heard you could do a self-managed super fund today. What are some of the things that differ between a self-managed and a normal super fund? Can you borrow? Can you buy property? How does that work? Yeah.
So with an industry fund or any other public auxiliary fund, the investments are done by fund managers, which 9 times out of 10 you don't know.
Yeah.
And they have a certain mandate they follow.
Yeah.
However, with a self-managed super fund, and with this industry fund, you're limited to what you can invest in, right?
Yeah.
You may be able to pick certain growth shares, etc.
Yeah.
But you can't pick directly into what you want to invest in exactly.
Yeah.
Self-managed super fund is exactly how it says in the name. It's self-managed.
Yeah.
So it gives you the ability to invest directly, whether it be property, shares, gold. In certain days, certain things you can even borrow. You could even lend your super fund to other businesses.
Yeah.
Let's say if you were a doctor, you can lend it to yourself as well.
Yeah.
But I think the best thing about a self-managed super fund is ability to leverage.
Yeah.
Let's say, we'll go whole numbers here. Let's say you have $200,000 in your super, right? And you're being super conservative. So the exposure to the market you have right now is $200,000.
Yeah.
We'll be super conservative, and let's say we'll go with a LVR or loan to value ratio of 70%.
Yeah.
You can go higher, but let's go 70%. Suddenly, you can now borrow to purchase a $500,000 property.
Yeah.
So with $200,000, so your exposure to the market goes from $200,000 to about $600,000.
Yeah.
In less than 2 months.
So let's just break that back down and unpack that. So if someone had 200 grand in their super and they're getting 5% return on that, they'll be getting 10 grand a year. But if they were to go and use that with a bit of leverage and go buy 600 grand worth of property and they only got 5% return on that, everyone loves my deals because they get a lot more than that. But let's just say they get 5% return on that, you're now getting 30 grand a year because you're getting the 5% on the 600 grand. People say, well, what about the debt component of it? Well, you've got the cash flow from the rent that's servicing the debt.
Absolutely.
Anyway.
The thing is, you get the cash flow from the debt, and knowing your properties, they'll be positively geared soon enough. Right?
Yeah.
So then your super guarantee payments that your employer pays, that cash component, we'll invest that part, grow that aggressively for you.
Yeah.
So another 12, 18 months, you're buying another property.
Yeah.
You're literally using the initial blueprint and just repeating it again and again and again.
Yeah.
So if you did that every year for 20 years before you retire, from let's say 40 to 65, you could amass anywhere between 10 to 20 properties before you retire.
Yeah.
And it's all under self-managed super fund.
Yeah.
I've got a very interesting story. I've got a client.
Yeah.
And this client is very smart by any standards because surgeons are naturally smart. Right? But he didn't realize he had to put these properties on the self-managed super fund.
Yeah.
Now he is 70.
Okay.
He's paying tax. Imagine that. He saved lives. He literally saved lives.
Yeah.
But the government says, well, you've made too much money. Yeah. You didn't structure it correctly.
Yeah.
So that rental income that you're getting, that $250,000 a year, we're going to tax it even though you're in your 70s.
Yeah.
That is ridiculous.
Yeah.
So by structuring within the SMSF, even let's say you have 15, 20 properties.
Yeah.
You're working well with Nathan. I'm giving you the good advice. The accountant's doing well.
Yeah.
Finance is all sorted out.
Yeah.
When you retire, guess how much tax you're paying on that SMSF? Nothing.
Yeah.
Absolutely nothing.
If you couldn't see it on the camera, I did my hands into a circle for zero.
Yeah. So, and then, we're going to do another podcast about this, but let's say you had 15 properties. You had a personal debt of $1 million, for example. You've retired.
Yeah.
You can sell all those properties.
Yeah.
At close to 0% tax. There may be some 10% tax because it's capped at, with self-managed super fund.
Yeah.
Take that amount, pay off your principal property.
Yeah.
Bob's your uncle.
Exactly.
You've got cash flow that's tax-free.
Yeah.
You've got a property that you've paid.
Yeah.
So, and all this while using leverage. So it's all using the bank's money.
Yeah.
Why? Have you ever seen the bank work for you? An SMSF allows the bank to work for you. So you're taking advantage of the system.
Well, the way I see it, right, like let's say you got the 200 grand and you put that into your normal industry super fund where they put their hands around and stuff like that, right? I'm not alleging anyone of doing anything, right? But those super funds, you don't know where your 200 grand is, right? And even if it is in like a property geared cash flow booster fund or whatever they want to name it as, right? Cool name. What does that really mean, right? I remember back in 2008 when the GFC was on, I was trading shares back then, right? As part of my property investing strategy, I had shares and I was trading shares, and I was day trading Centro stock, right? And if you remember Centro, that shopping centre, and there was two sets of shares. There was one that was a management firm and there was one that was a property real estate firm. And when the GFC came, it got wiped out. And I just look at it and I think, it doesn't matter which super fund you've got, what does that mean that it's in a cash flow booster, right? Is it a derivative that they're turning into debt to fund a project of a shopping centre? Because I don't see, a major retail shopping centre like Westfield, for example, going to CommBank and saying, oh, hey, CommBank, can I get a loan for 95% LVR? I want to build a new car park out the back. They have to go raise capital, right? So what sort of 10th level down derivative of a derivative is your money funding, and what's the outcome going to be to you? I always think that.
Yeah, you're right. So if we take other examples, when a big company, because I don't want to mention any names.
Yeah, don't mention any names.
When a big company wants to raise funds, they usually do something known as a convertible note.
Yeah.
And it's a bond, essentially, right? So what they're doing is you're investing in their company.
Yeah.
They're taking your investment, they're leveraging your investment, not their money. Because have you ever realized one thing? When these big companies, when they go broke, if the government doesn't bail them out, the directors remain rich.
Yeah.
Ever noticed that?
I always say it. Yes.
So they put your money at risk.
Yeah.
And then they leverage it up to the tits.
Yeah.
And then they hope for the best.
Yeah.
If it works, it works. If it doesn't work, then you get the GFC.
Yeah.
Where government has to a bailout.
Yeah.
And if they don't bail you out, they're done.
Yeah.
So why not? So if someone can do that to your money, but why don't you do it yourself?
Exactly.
Leverage it up with the banks yourself.
Yeah.
And then you're responsible for it, which is fine when you have great advisors like us around.
Yeah.
It's going to be, it's easy breezy.
Yeah.
When you have us around.
Yeah.
And if anything happens, we're protecting you. We're protecting you by making sure you have a corporate trustee and a self-managed super fund.
Yeah.
That your personal assets aren't attached.
Yeah.
So worst case scenario is you're giving it a go. Yeah. And if it doesn't work out your way, just walk away scot-free.
And you can always sell the asset. You've always got the asset. Mm-hmm. I look at super funds that people don't really realize that, right? Like, so if someone goes and earns 500 grand in buying a property, selling it, they've got to pay. And we're not getting into any tax advice today, folks, but like...
No tax advice.
No tax advice. But let's say someone earns $500,000, they've got to go pay $500,000 worth of tax, which let's say it's at 30% or 40%. Let's just use 30% for the fun of it, right? Which is not going to be, but let's say that. There's 30% of 500. There's 150K that's gone out of that. So you only get 350K out of your 500. But if you made 500 grand in your super fund and you had to sell it and, so the super fund tax is at 15%. Yeah. No matter what you make, right? Yeah.
Of course, you have to make a profit in order to pay tax. Yeah. But the great thing is, if you own a property, over 12 months, CGT is capped at 10%. So what I've done with my clients, and you probably advise them something similar, is there's a growth phase and a cash flow phase. In the growth phase, we're buying residential properties. Yeah. Because we don't care about the CGT implications when we sell it. So when we sell them, the client's getting 6-7% a year. Yeah. Plus the equity growth. Yeah. Right? They reach 55, 60. We sell all the properties. Yeah. Whatever cash we get then, we're buying commercial properties. Yeah. Higher cash flow. Yeah. On top of that, they're just paying 10% tax. Yeah. And then they know that we can retire because with your commercial properties, what are the returns again in your commercial properties?
I find
an average one. Don't give your good ones.
No. Like for me, like when I buy commercial, like most of my commercial are offices and stuff that I use. I've got some that are like 25%, but I've still got residential that give me. I just bought residential property. Here's a fun one. I haven't shared this. I'm going to do another podcast shortly about the properties I bought in 2025. I bought some duplex pairs for 158 grand recently, rent for $600 a week.
Wow.
So like it's in Brisbane. Yeah. So looking at, cash flow, I still see great cash flow on residential and commercial. I don't see one over the other, but to the side of that, like you can't pull equity from the super, right?
You can't. Yeah.
So if you buy property for 200, it goes to 600. You made 400 grand in your personal name. You go pull out 250 out of that, go use that as deposits. In a super, you can't. But if you choose to sell it, the tax is minimal, and you do the same sort of thing. So whether it's buying commercial, whether it's buying a block of units, whether it's buying more of the same sort of thing. Some of our mutual clients have had one. They've, it's tripled in value in the last 5 years. They sell it. They go and buy another 4 properties. That's their strategy inside the super to boost that up for retirement. Yeah.
So give me a round figure for commercial property.
Say 9%, 10%.
10%. Okay, let's say 10%.
Yeah.
Residential properties are giving you 5%. So let's say 6% residential properties.
My ones are giving like 7 to 8.
Higher, but
on average, yeah.
You have to remember there's other costs associated with it, like anything that you have to fix, strata, etc. I'm not saying there aren't stratas.
Yeah.
You buy a commercial property. Let's say you're about to retire. You're 65. You're about to retire.
Yeah.
You don't give a crap about paying for people's stratas and fixing up the stuff. You just want something simple.
Yeah.
You sell your residentials, buy a commercial property.
Yeah.
You're going to get your 9-10%.
Yeah.
On $1 million.
Yeah.
That's 120 grand.
Yeah.
And all your other debts are paid off, and you don't have to worry about anything else, because anything that happens in a commercial property, the tenant fixes it.
Yeah.
Right?
Yeah.
You've got cash flow.
Yeah.
And then you travel the world, do whatever you want.
Yeah.
But you never have to worry about something. That's the reason why my older clients do sell their residentials for commercial. But working with Nathan, I'm sure they'll build a better portfolio, a better property portfolio.
Yeah.
Then
Although I think it's good to have a mix of resi, commercial. People always say commercial's the best thing and all that. Well, I've got one. I just leased it yesterday. I had the property at some big medical complex, and I had one that was vacant for 7 years since I've owned it, or 8 years since I've owned it, out of all the shops. And sometimes like my exposure, like my favorite property is a commercial. I bought it for 400. I rented it for 20 years at 100 grand a year, paid in advance to an ASX listed 200 company. Property's worth probably 3 mil, so it's gone up, quite considerably. But that thing was vacant for 11 years before I bought it. It was an old Video Easy store, so whoever owned it could have done their ass for that long. But like I look at them like the property is always the vehicle, as we talk about, right? The property's the vehicle to get us from where we are to where we want to be, and at every stage, everybody's position is different. And someone that's we're at a point now where we're getting second generation investors, where someone came in 15 years ago and they've got like a 3-year-old or a 5-year-old, and now they're coming back and their 3-year-old is now fucking buying properties. And so it's quite interesting. And at different stages, like the advice that I give to the kids is different, totally different from what to give to the parents, because they're the parents have got all the equity and they've got a higher cash flow, but the kid's got 40 years worth of work life. I had an event recently, and there's clients that are joining up and they've bought like 4 or 5 properties and they've got fucking braces and stuff. And I'm like, ask me for advice. I'm like, man, if I could swap all my wealth and take an 18-year-old body, like be young again, it's like, that's the wealth right there, right? I'd cause bigger damage to what I've done in the last 20 years. But everybody's position is different, and it's like finding that right strategy that's going to fit. And there's no one size that
absolutely, and that's what we're here at Granada Wealth Advisory. That's what we're here for.
Yeah.
Like you mentioned, I'm just going to reiterate: there's a different stage of life for everyone. Your strategy is completely separate to someone else's.
Yeah.
There is a common theme, which is yes, we are geared towards property, but how we purchase a property, how we're going to structure it, how the cash flow looks like, it's completely different. Yeah. So on a macro level, you might think, oh, it's all the same, just buy property and that's it. No.
Yeah.
On a micro level, when you really dig into it, how do we structure it? Yeah. This is all the advice that you need.
Yeah.
Look, you can sit down there and do everything yourself, right?
Yeah.
But if my car is broke, I will take it to a mechanic.
I was literally just thinking about cars before you said that. I was thinking of something different, but yeah.
Exactly, right. We go to a mechanic.
Yeah.
So it's the investment you put into yourself, and that investment includes getting good advice by people who've had the experience, and so you don't make the mistakes that your average person does.
The thing I was thinking about with cars is, people don't go fix their cars, right? Some people do, some people don't. Like, no, the mechanic always has the worst car, right? The builder always has a half-built house, right? And looking at the vehicles, right? Like, if we hop out on the closest freeway that's out here, there's a freeway just down the road, and go for a drive along that, you'll see a sports car, a pile of Teslas, right? They're trying to force everyone into. Then you see big trucks, right? And then you'll see a four-wheel drive, you see a soccer mum, right? And each one of those vehicles is on the road. Yeah, they've still got 4 wheels on it, or they might have 20 wheels on it, right? But they've still got the same engine going and all that. But they've all got a different journey that they're traveling on. They've got a different purpose for being on that road. They've got a different start point and exit point. And that's the interesting thing that, you know, we share with our clients is that journey of going, okay, what vehicle do you need at what time? And people come to us. It's not like, hey, yeah, we're going to take your money and we'll give you a return on it and don't ask where it's in and stuff like that, which is what's happening with your industry super fund. You know, we're like, okay, these are the options, right? Which vehicle do you want to hop into? If you hop into this one, this is where we're going. This is the next one.
Very poetic, might I add.
Really? I like the analogies. So,
You know, without going down that road, Wilbur Frost did say it's not about the destination, it's all about the journey. Right?
Exactly.
So everyone's journey will be different, and we're here to help.
Yeah. And so looking at some takeaways for people, like if they're thinking of doing a super fund, what would be the entry point that people would normally look at for getting into super?
So I would like to preface this by saying this is general advice only. Anything I say does not take into account your personal financial situation.
So it's not like an average entry point.
Yeah.
Like,
so an average entry point would be between $200,000 to $250,000.
Yeah.
If you work with certain accountants and certain financial planners, we can make it work below that.
Yeah.
There are certain requirements that we have to ensure happens, but we can do that.
Yeah.
Now, the entry point then determines the property that you can buy.
Yeah.
And this is where you and your team come in. You make sure everything is done quite well, and they're not buying some. Of course, they're going to buy good properties. I'm not even going to down that road. So there's $250,000 entry point. And then we set up between the accountant and I, we will set up the SMSF for you. We'll give the advice in order to do so.
Yeah.
Make sure everything is compliant, because the last thing you want to do is not be compliant.
The compliance, folks, is the biggest fucking thing that's important, right? And I'll do the swearing on this, right? Because it needs to be really fucking hit home, right? The reason why I have always said financial planners, you need to be very careful of them. And we've done lots and lots of, super funds together, and the team that's behind that as well. I've seen planners come to us, do the super fund setup, and it's rubbish, right? Like we've turned investors away because we're like, that is not compliant, because you have issues of double stamping potentially at the end, tax ramifications. Maybe you can go into some of the compliance that people should be mindful of, like just.
So one of the few things that one of the many things I see is once we set up, once a client sets up a self-managed super fund by themselves, this is without accountant advice or anything, which you can do online, by the way, which I highly discourage you to do. They can't seem to roll the funds over. And the reason why they can't is because they didn't set up the name correctly. And then instead of something that will take you about 2 to 3 weeks to do, it takes them 6 months to do, because then you have to reissue the trust, pay more money to get that done, reissue the rollover, ensure the name matches, and it becomes a complete disaster. Another thing I see is, and I'm sure this doesn't happen with your clients, is they purchase a property and then they rent it out to their own family. Yeah. That is a big no-no, big red flag. Right?
You can't take personal benefit.
Everything has to be at minimum 1 arm's length. So it has to be way further than that. You cannot rent it to yourself. You can't rent it to your family. You can't use it as a holiday house. Because once the ATO gets a whiff of that, they will shut it down, fine you. So it's not about shutting down the super. It's about getting.
It goes from like administration and liquidation.
They will fine you.
Yeah.
These are the pitfalls that, with guidance and proper advice, you won't get.
Yeah.
So it'll be a process where it'll take you 2 to 3 weeks to set up.
Yeah.
Another week or so just to roll everything over.
Yeah.
And then a few weeks to fund a property, you'd say.
Yeah. And then the loan perspective takes double the length of a normal loan because it's all manual and.
So as long as you deal with a team that is compliant, everything can be done with a breeze. Because if it's not compliant, the loan is going to be a pain.
Yeah.
The setting up is going to be a pain. The finding the property is a pain. Because even the name of the property has to be under the SMSF using a bare trust on top.
Yeah.
Which a lot of people don't understand because they haven't gone through it.
Maybe on that front, like without getting too technical and boring people and setting them to sleep with it, right? Because we try to make finance stuff fun. I don't think it's anyone that's out there that really makes finance fun and in a comedic way, right? But with that process, so you have a bare trust. How does that work? Does a bare trust stay there forever? What happens if you have no loan on it afterwards? Like, how does that process work, like of the bare trust?
So in order for you to borrow through an SMSF, because it's a non-living entity, the government doesn't allow that until you have a bare trust. A bare trust is a special trust which allows the SMSF to borrow property. Yeah. Now, you have that bare trust as long as a property has a loan. And then the moment the loan's paid out, the bare trust disappears. Yeah. So for every separate property that you purchase, you get a new bare trust. Yeah. On top of that, with that bare trust, normally you will have a corporate trustee attached to your self-managed super fund. Yeah. So that limits your liability. Yeah. So for example, if something happens to the property and you can't continue paying it off, you just sell the asset and you are not person liable. So you can have millions of dollars in personal wealth. Yeah. If everything goes wrong with you, with your SMSF, you're not person liable. And this is what I was talking about previously with the directors of these $1 million companies. Yeah. When the company goes down, the directors remain millionaires, right? Yeah, yeah. And you can take the same advantage. So if your SMSF goes down, you're absolutely fine. And the lending is very different. Like, I've seen people that might have, 10 kids, a wife that doesn't work, and they're on 150 grand income, and they've got, 20 properties with $5 million worth of debt. I'm just making this up. This is all bullshit, right? Yeah, 10 kids in Australia. It's a rarity today, right? Let's assume they did. So you go to the bank, you can't get a loan under your personal name. But when you go to get a loan under your super fund, they'll look at your contributions to the super and they base the income. Absolutely. So like I mentioned earlier, the SMSF is a completely separate entity. Yeah. So they don't even look at any debt you have. They look at your contributions and look at the amount of super that you have in there. Yeah. So if you're an average Aussie earning $150,000, you're getting about $15,000 to $17,000 in your super guarantee every year. Yeah. Let's say you had a healthy balance of $300,000. Yeah. You can easily buy a property that's serviceable. Like, you can easily buy $800,000 property. Yeah. Without even them asking you another question. Yeah. And then if you contribute more because you have a cap of $30,000, so let's say you contribute another $13,000 in your super to lower your taxable income, although this is not tax advice. Yeah. You could even purchase even higher property. Yeah. So you could have truckloads of debt. Yeah. And still purchase property with the SMSF. Yeah. So this is where I'm just saying there's a whole new world out there. Yeah. Not that I want to quote Aladdin. That's whole new world. And it's all for you to explore and see. Yeah. Beautiful. And I had some notes. I haven't even looked at the notes really for the day. I was just, Is there any final notes that you wish to share or impart on anyone today about super fund or? I think super is something that you need to check ASAP. Yeah. While you're watching this video, open up a new window and check what your super is doing. Yeah. And if it's not doing enough, contact us. Yeah. My website's Granada WA, so granadawealthadvisory.com.au. Yeah. Contact Nate's team, my team, and we'll work out a way better plan to ensure the super funds are working properly for you. Yeah. No matter what your balance is. Even just a checkup. What was the last time you reviewed your position and go, hey, what? Most people don't even know the login details of how to get into the super, right? If they do, just don't know, like it's just there. Oh, do you want to
do something with it. Oh, no, I just want to keep it separate, you know. It's just as a protection for when I get older. It's like, hey, it's still like $250,000, $500,000 of your money. I think it's always important to review. It's like I was saying to someone just recently, I got fat a few years ago, right? And these old videos, I look like bloody big bloated. I look like Peter Griffin, right? I did, no joke, right? And when I got fat, I didn't want to look in the mirror because I was like, fuck, don't look at the fat freak there, right? And then it was just like you want to ignore it, right? So when someone's got an unhealthy problem, they're like, I don't want to face that problem. Mm-hmm. So when it comes down to your finances, a lot of people go, I'd just rather not look at it. So it's okay just to ignore it. But if you've got a bad relationship with it, you have a bad relationship with your spouse, your relationship doesn't work. You've got a bad relationship with your kids, then your kids don't have a good relationship when you get older. You have a bad relationship with your money and you don't respect your money, someone else is going to respect it, show it more love, and it's going to disappear and go over with them. So I think it's
actually important. In saying that, he brought up a very, very good what's it called, proposal, actually.
Yeah.
I get that with my clients all the time. They don't want to see anything.
Yeah.
So how about this?
Yeah.
I'm happy to offer the clients 30-minute quick review on the house.
Yeah.
You don't even have to look at your super.
Yeah.
We'll look at it for you. We'll look at it for you. As long as it's on the right forms, we'll look at it for you. Okay. And we'll review it for you. Okay. 30 minutes. Okay. On the house.
Beautiful. How would someone contact you?
They can go to my website, www.granadawa.com.au. So it's Granada Wealth Advisory.
Do you have an email address?
Yes. It is Afiq, AFIQ. That is Alpha Foxtrot India Quebec. At granadawa.com.au.
We'll put the link on the screen with the
Oh, there's admins as well. Me and my team we've got a fair few advisors with us already. We'll do a quick 30-minute review for you on the house. And if you don't want to look in the mirror, we'll look in the mirror with you.
Beautiful. Just made me think about that, as I said, like a bad relationship or whatever the case may be. Made me think, like, if someone's got like say $100,000, right? And they're like, shit, I can't do anything. But if you've got a husband and a wife that got $100,000 each, like, tell me a bit more about what
90% of my clients and your clients are partnered with someone. So if they have $150,000 and their partner has $150,000, voila, $300,000. And that means better borrowing capacity because it's two people with super guarantees, bigger balance as well. And the administration costs is shared. So right now you'd be paying a lot more than that to keep two separate supers, and you just combine them together and you'd have one super to manage.
Could we get 50 people in the one or not?
Maximum is capped at 6 now.
6? Okay. 6, yes. I thought it was 4 before.
It was 4 before. Some states are still 4. But if you're in New South Wales, it's 6. So 6 trustees.
So if you got mum, dad, 4 kids, 4 siblings.
4 siblings, 2
families.
2 families,
2 couples.
The thing, 3 swinging couples.
Sorry?
3 swinging couples.
3 swinging couples. A harem, right? So,
there's nothing wrong with it.
There's nothing wrong with that. Everyone's got their position. Sounds pretty fun. But with it, the other thing that I always like to draw people's attention to, people go, I should go halves with a friend or whatever. When it comes to the super fund, I always think, like, you might be 30 years old today and you've got your best mate you're going to, set up a self-managed super fund with. You got to take this shit through retirement, right? For me personally, I'm like, very close family, if that, friends, that be very careful with who you're partnering in is what I'm thinking. But
I've had this experience through time and time again. To be honest with you, Nate, I would prefer if there was only couples that did it. Couples and maybe their parents. I've seen 2 brothers do it. Both got married later on in life. One couple got divorced. And they had a few properties together within the SMSF. She took the brother one through the ringer. So they've had to liquidate their properties in order to pay her out because they just weren't liquid enough, right? Although I've seen best friends do it and it's being fine and dandy and they're retiring together. So just pick your...
Exactly.
And just pick your partners wisely.
And different phases of your life as well. Because for example, my mum's in her 80s and they've got a brother in his 50s and they bought properties like 30 years ago, 20 years ago. But mum's at a point where she's like, I'd be happy to sell down some of these things, right? And my brother's like, no, I'm just holding on, right? It puts in different phases in your life. You could have two 30-year-olds. Let's say you got two 30-year-old siblings, and one goes off to travel and do Kentucky for the next 10 years and, party. And the other one goes and has a family and settles down. They're two different life journeys, and it's a very difficult position when you have to go to a sibling or whatnot and be like, hey, we're having a harsh decision. This has to be sold or whatnot. So, it's my 2 cents on it. No financial advice. Everyone do what they want, but
that is something that, we'll normally talk about with both parties. That's part of our job, is to ensure that everybody understands responsibilities.
Yeah.
And it's happened a few times, and not all the time. It's happened a few times where they've reassessed the situation and thought, you know what? Instead of doing it together, we might have our own separate SMSF just in case, because I've seen it time and time again. Not often, it is rare, but it still happens. And I'd hate for to be the next statistic or the next rare event.
Yeah,
absolutely.
Cool. Well, I appreciate the conversation today. We'll do a whiteboard session shortly talking about super funds and different benefits to it. And thanks a lot for all the help that you do for our clients in the community.
Thank you very much for having me.
Appreciate it, Afiq. Thanks a lot for tuning in, everyone. If you have any questions, drop them below. Reach us out, admin at B.Invested.com.au, 1300 367 925. Watch us every Thursday, Google Play, Apple Play, Spotify, and YouTube. Have a great week, and see you next Thursday. Bye for now.
Like Bilal said, man, we're stuck in the matrix. This my advice, don't care if you take it.